Welcome, everybody. We have almost 70 participants, over 70 participants jumping in. Might be a Frazier Financial webinar record. Josh, kick us off.
So today we're going to talk about the new tax bill. And for pretty much everybody on this call, taxes are the biggest expense in your lifetime. So there's going to be thousands, maybe tens of thousands of dollars of planning opportunities for our clients over the next few years, and hundreds of pages to sort through. Luckily, we've got a national expert. We call him the expert to the experts on the tax side, your doctor's doctor, if you will, to help us sort through the hundreds of pages and more clarification to come on the new bill. Vanguard has done a survey and study the last 25 years on how top advisors add value for their clients. They estimate that to be about 3% per year in additional returns if you have a great advisor. And about half that is coming from smart tax strategies. So that's what we look to cover today. The bill is called the One Big Beautiful Bill Act. And we're going to try to stay away from if the bill is beautiful or not. It's not really our point of the call to figure out if it's great for the country or great for our budget, but it's more so how to make this bill beautiful for you and your family. So I'll kick it back to you, Brian.
That's good stuff, Josh. We've got 90 participants, so still people coming in here, but we're going to keep moving and go ahead and jump in. I will introduce our very famous guest. As Josh said, Jeff Levine is kind of the advisor to advisors. And so we've met him a few times here and there at conferences. He gives away an enormous amount of content and information very generously on his social media pages, and he makes many advisors look smarter than they might deserve on their own. And so we're really excited to have him here talking to us today. For those of you who maybe haven't been on our webinars, you probably know one of us, but Josh Frazier's on my left. I'm Brian Houts. Jeff is the good-looking guy in the vest there that you'll see pop up on screen soon. Jeff, I'm going to skip a lot of your bio because you can probably do a better version than I can, but Jeff has more alphabet soup than almost anyone you'll meet. So you can see under his name there, he has many, many credentials and a lot of education and background. Jeff does work for a firm that is somewhat like us. They're a larger national firm. And so he still does client work. He writes a lot of blogs. He speaks at all of the major conferences, including next spring. He's going to be in Columbus, Ohio, talking to a advisor group that I'm leading. And so I'll skip that last paragraph. He's been quoted pretty much everywhere, and we won't read through that full paragraph. So Jeff, really appreciate you being with us today. I'm going to drop this share, and the floor is yours.
Awesome. Well, thank you so much. And thank you all for joining. What a great thing to take some time out of your day to focus on saving money on taxes, something I'm super passionate about. And I would be remiss if I didn't thank my friends at Frazier Financial for giving me this opportunity and this platform. There are so few firms who really take the time and energy to invest in educating their clients like the Frazier Financial folks. And, you know, you'll hear me say it a lot of times, but I really believe that better educated people make better decisions, and better decisions on the whole lead to better outcomes. And that's something that both my friends at Frazier Financial and I are super passionate about. So with no further ado, let me dive right into our material. I'm going to go ahead and share my slides. I see we've ticked up over 100 people, which is pretty awesome to be joining us for today. I'm actually going to share my slides as soon as you all give me a little bit of permission to do so. So while we fix that, let me just start by sharing something, and that is a little bit of housekeeping for what we're going to do today. We're going to cover the bill in, I'm not going to say in its entirety, but a wide swath of the provisions that are there. Now, some may be more relevant to you than others. For instance, if you're not a business owner, you don't really care about the changes that apply to business owners. I would try to take away the 3 or 4 things that are most relevant to you. And this is about information and education. Ultimately, the advice, the personalized guidance, that's what you have your advisor at Frazier Financial for. And oftentimes they're going to work collaboratively either internally with the tax team, or if you have an external tax professional, professional, you're going to get that sort of guidance personalized to you based on your specific scenario. But if you have a question, I'd love to hear from you. The Q&A box is enabled at the bottom of the screen, and you'll see me from time to time peer over at another monitor I have here just to check to see if if there are any questions. And I'd rather you ask them while you have them than wait until the end. I'm not going to reserve like 15 minutes at the end for Q&A. I'm going to try to take questions throughout, because if you have a question while we're on a particular topic, better to address it then and there. All right, so with that said, let me share with you one other key point here, and that's you'll see a lot of the provisions in this bill are referred to as permanent. Permanent is a really weird word when it comes to tax policy, because in just about anything else, permanent means like what we think about in the English language, like forever, right? Permanent. For instance, I have 3 kids, 3 young boys. It's loud in my house at all times, as you can imagine. And, one of the things that we are always very cognizant about, they love doodling and coloring and things like that. We always say, don't use permanent marker. Why? Because they're doing it on the carpet, or they're doing it on one of the nice tables like the dining room, and we don't want it to stain forever. That's what permanent means. But when it comes to the tax code, permanent really just means there's no stated end date in the law that is set to sunset that. And more, it means that we're going to have this policy here until some other future Congress changes it afterwards. So it takes an act of Congress to reverse it rather than something that's going to happen, quote unquote, naturally. So if you think about the Tax Cut and Jobs Act that was passed back in 2017, many of those changes were set to expire this year, if not for the One Big Beautiful Bill Act. But thankfully, or at least for many of you, thankfully, we've got that One Big Beautiful Bill Act to save you taxes going forward. All right, so good news is we are all set to run with our slides. You should see that here. And we're going to go ahead and dive right into the material. I'm going to skip what we're going to cover because you will see that. And I'm going to go right into our changes. So the first thing of note is that those tax brackets that we've had in place over the last 7 or 8 years or so are now the quote unquote permanent brackets. Again, here until some future Congress changes its mind. Now, everyone is different. Everyone has an opinion. But I will tell you, I still believe that over the long run, tax rates are likely to rise. I think when you look at the deficit spending that we have, when you look at the national debt, I think it's very hard to imagine, in my opinion at least, a scenario where at some point the chickens don't come to roost and we don't have a scenario where tax rates rise to help cover those costs that we have incurred in the over the last several decades. Now, we could certainly have economic growth, and that could help with a lot of that. In a really optimistic scenario, we could kind of cover it all over a long enough period of time. But I think the most likely outcome, and most experts agree, that there's going to have to be a rise in rates at some point in the future. The question is when that will be. A lot of people thought it would happen already. It hasn't. And if anything, we're seeing tax rates continue to drop or to stay low. Where this matters is because tax policy is only here until it's not, right? If permanent is only permanent until some future Congress changes its mind, whenever there's a low rate environment, if you believe that to be the case, it makes extra sense to take advantage of that low rate environment. And it's a combination of both the external factors, in other words, what is the rates set by Congress, but also your personal income, right? If your income is very high now and it's going to be very low later on, say in retirement, even if the rates overall rise, it might still be better off for you to delay paying tax. But sometimes it pays to pull income forward via things like Roth conversions, et cetera. And that's why I know, your advisors at Frazier Financial are constantly looking at things like that to figure out when is the optimum time for you to pay tax to create the lowest lifetime tax bill. And that's really what you should focus on. It's not creating the lowest tax bill in any one year. It's helping to create the lowest lifetime tax bill for you and your family. And when it comes to some of your assets, like retirement accounts, where the tax bill doesn't go away when you die, it passes on to an heir, it's not even the lowest lifetime tax bill, it's the lowest multi-generational tax bill in many cases. Now, other things that are staying the same or roughly the same are the higher standard deduction. You may remember back before 2018, the standard deduction was much lower. The Tax Cut and Jobs Act roughly doubled that. That is now permanent as well with an additional small boost. And what this means is that because the standard deduction remains so high, most of you will continue to be taking the standard deduction, right? The higher the standard deduction, the more people claim it, because when we're looking at what you claim on your tax return, it's either your itemized deductions, things like charitable contributions, mortgage interest, deductible medical expenses, state and local taxes, and you kind of add all those up and you see how high they are. And then you compare that to your particular standard deduction based on your age and your filing status, and you see which is higher, and that's the one you generally take. Well, the higher the standard deduction, the harder it is for all those other things to get above that amount. And so because that standard deduction will remain high, many of you, in fact, probably most of you, will continue to take it. And the good news is at least that's easy, right? Like, you don't have to keep track of your charitable contributions or things like that when you take your standard deduction. So it does make life a little bit easier. Now, because of some other changes, even though it's a smaller percentage of you, more people this year will itemize than they did last year. We'll cover that in just a bit, but most of you will continue to take the standard deduction. Now, with regard to itemized deductions, there's a lot of things here on the screen that we just want to make you aware of. I'm going to highlight two of them in particular. And again, all these changes are permanent, quote unquote. One is miscellaneous itemized deductions remain repealed. So on that top line there, right, these are things like, you may remember in years past, you used to be able to deduct like unreimbursed employee expenses or unreimbursed business expenses as an employee, I should say. Or perhaps you were deducting your Frazier financial advisory fees or the fees to prepare your tax return. Those are non-deductible on your personal return, and that continues to be the case. So one of the things we often look to see is, can we allocate some of this elsewhere? In other words, if some of the planning being done is for your business, are some of your fees, whether it's advisory fees or tax return fees, are they attributable to your business, and can we deduct it there on your business return as a legitimate business expense versus being on your personal side of the return where it is non-deductible going forward? The other thing I'll point out is the mortgage interest deduction continues to be capped. Now, this is for new mortgages, for those that were taken out after the Tax Cut and Jobs Act was effective, but that's a $750,000 maximum principal amount. So if you borrow $1 million, only 3/4 of your interest, the first $750,000 of principal, the interest on that is deductible. And that's a bigger deal today than it ever has been before. Now, certainly if you look at national home prices, most homes that are purchased are still below that amount. And, obviously there's geographic disparities as well. But many of you on this call may be fortunate enough to be able to afford a larger home, right? You've done a great job saving, or you've put in the work to get a higher income, and you may find yourself eligible to buy a home north of that price, or at least borrow more than $750,000. If you do, you should just know that, again, the excess interest above $750,000 of principal is non-deductible, which does have a more significant impact today than ever before. One, because home prices today are higher than ever before on average, and two, because interest rates today are higher than they were back in, let's say, 2018 or 19. So there's higher interest on more debt that is non-deductible, and that does just increase the cost of buying a home. Again, if you're thinking about whether you can afford a home, buy a home, what's the right thing for you to do, pay in cash, pay a mortgage, those are great questions to raise with your Frazier financial advisor. All right, as we think about some other items here, these are a little bit less likely to apply to you, but the moving expense deduction that used to be available, that is permanently eliminated unless you're in the military, and deductions for personal exemptions. You may recall in years past, there was like one deduction for each member of your family. That is also permanently repealed. For those of you who have young children like I do, the child tax credit remains relatively high. If not for this law, it was set to go back to $1,000 per eligible child next year. Because of the One Big Beautiful Bill Act, it's actually going to stay at the higher elevated amount, actually a little bit of an additional bump up to $2,200. And a significant portion of that, up to $1,700, is going to be refundable as well if you have a net negative tax liability, and that will be adjusted for inflation. And if you're below about $400,000 of income, you are actually eligible for these credits. So it takes a lot of income before these child tax credits phase out. So many of you with young children will qualify for those continuously. Let's shift on and talk about a provision that may impact some of you who are business owners, or also applies if you have things like REIT dividends, et cetera. And that's the qualified business income tax deduction. This was a brand new deduction created by the Tax Cuts and Jobs Act. And what it did was it said, primarily, if you're a business owner, then up to 20% of your business profits are eligible as a deduction on your personal income tax return. So this applies to owners of S corporations and partnerships and sole proprietorships and things like that. And the rules are slightly different depending upon what type of business you have and how high or low your income is. But in many respects, or in many cases, we're talking about really significant deductions of $10,000, $20,000, $100,000 or more a year for high income, high earning business owners. The note here is that that is a permanent provision of the law going forward. Now, if you are really into this stuff like I am, you probably read a lot of articles about big changes to that QBI deduction that were created by some early draft legislation. In short, while I won't bore you with the details, a lot more business owners who are doctors, lawyers, accountants, financial advisors, like white collar service type jobs, were going to be able to claim this deduction even at high income amounts. Unfortunately for those folks, those changes were kind of scrapped in the final version of the bill, and the final version really just takes the existing QBI rules and extends them permanently in the future with only minor changes that you see here on the screen. If you have an employer, I'm actually going to move forward past this one. You're welcome to read this. It simply says if you are receiving up to $5,250 of assistance from employers, that's for your student loans, that can be tax-free. I want to spend some more significant time, though, on the changes that are likely to be more applicable to more of you. And so one of them here is if any of you have a special needs child or a special needs grandchild or a friend of the family, anyone else in your life who has a special, who is a special needs person, then there are some changes here that were made permanent by the One Big Beautiful Bill Act for what are called 529A or ABLE accounts. These are those accounts where normally if someone is receiving government assistance, if they have a bunch of assets in their own name, they may be phased out of that government assistance, that, things like Medicaid or SSI, Social Security income, they may be phased out of receiving those benefits. The ABLE account rules allow them to have roughly $100,000 in this type of account and not impact their Medicaid eligibility or Social Security. So there are some meaningful changes here that are made permanent. Again, these aren't new things. These are just extensions of the existing rules that we've already had. The biggest one here perhaps is that if you have a 529 plan that you save for this individual, like the educational savings account, that can be moved over into a ABLE account, and there are a lot more flexible expenses there. Again, if this doesn't apply to you, don't really pay too much attention. Don't waste the brain space. Wait till the next provisions that apply. And I'm going to go ahead and move on and talk to you about now what is meaningfully different. So let's talk about what is meaningfully different in the tax law today. And just a reminder, if you guys have questions, if any of you have questions, please don't hesitate. Go ahead and type those into the Q&A box is the best place. I do see a couple of questions came in here through the through the chat. If you can, it's easier to put those to the Q&A, but I see them in the chat right now. So let me go ahead and answer some of those. So one of them says, are these changes only effective for tax years in 2026? Many of the changes that we talked about so far are effective only next year. But when it comes to a big bill like this, oftentimes there are different effective dates for different provisions. And so, for example, we talked about the child tax credit, right? Or the standard deduction. Those are both increased as of this year compared to what they were going to be absent this bill. But the changes to things like the QBI deduction or some of the other items that we talked about, those are effective next year. So it's really a smattering of when these things are effective. And I've tried to give you the effective date on each of these slides. And certainly what I will do is I'll make these slides available to your Frazier Financial advisory team, and they can, as long as it's okay with compliance, their compliance team, they can make that available to you as well. All right, so let's talk about some things that are meaningfully different. So everything we talked about already is something that is basically the same but extended into the future, right? Something that was going to go away, but is now just a permanent feature of the law or extended, and either it's exactly the same or it's pretty darn close. Now we're going to talk about things that are existing in the law but are being extended into the future with very meaningful changes. And there's no more significant place to start here than the SALT deduction cap. So very quickly, before we go any further, SALT stands for state and local taxes. That's generally your state income tax, your state property taxes combined. And what you see here is that effective this year, so this goes back to the question that was asked, this is actually not a change just for next year and beyond. This is a change that under the law is changing the way the rules work for this year, okay? We were going to only be able to deduct $10,000 per person for state and local taxes. Now we're going to be able to increase that to as much as $40,000 for this year for everyone other than those of you who are married but file separate returns from your spouse. By the way, just to head off this question at the pass, you can see that letters M, F, S. They are several times on the screen. That is just the abbreviation for married filing separate returns. So if you file joint, if you file single, if you file head of household, if you're a qualifying widower, all of those things, all of those filing statuses get the $40,000 new cap. So that's 4 times what we were getting before. That's a pretty big deal. However, right, there's usually, when it comes to the tax policy, there's almost always a but, right? And here's the but. The but is that $40,000 new maximum, that's much more significant than the $10,000 cap we had, is going to be phased down back to the $10,000 limit if your income exceeds $500,000, half that for those who are married filing separate. So what happens is from $500,000 to $600,000 of income, you not only add $100,000 of real income to your return, but you can lose up to $30,000 of your state and local taxes as a deduction because it phases out. Now, it can't be any worse than it's been for the last few years, right? We've been able to deduct only $10,000. That's the minimum. That's the most it can be phased out to in a worst case scenario. If you make $1 billion a year, good for you, first of all. But second, you can still deduct $10,000 of state and local taxes. But if you're below $500,000 of income, AGI, then you're going to be able to deduct up to $40,000 of state and local taxes. So let me stop here. Actually, let me answer a question that came in. Good, I love the questions coming in. So does the SALT 40K deduction apply if you own multiple houses, primary and a secondary home? It absolutely does. And what I would also share with you is that if that secondary home is a rental home, the SALT deduction doesn't really, like the limit doesn't apply there because that becomes an expense of your rental property. But if this is like a vacation home or, you know, a truly like you just live in 2 different places, then yes, the combined cap is still applicable there, and you can total those things up for the taxes paid on both properties and your income taxes. Great question, and thank you for asking it. So let's take a few moments here and unpack the state and local taxes. And I want to spend a little bit more time here than elsewhere because this is a big deal for many of you for a couple of reasons. One is, first off, I just want to explain like how wacky the tax code can be, right? So here's an example. Let's say you and your spouse or you and a future spouse are about to get married. And you're going to get married January 1st next year. And let's just imagine that each of you has a really good income. You each make $400,000 a year. Okay, pretty darn good, right? This year, because you're not getting married till next year, you're filing single. Each of you, because your incomes are below $500,000, could deduct $40,000 of state and local taxes. So for a total of $80,000 of deductions across your two tax returns this year. But you get married January 1st next year. So your $40,000 each goes to become a single $40,000 limit. So instantaneously, by getting married, you just lost $40,000 of deductions. But not only that, now, because you collectively have not $400,000, but $800,000 of income, now you have more income than $600,000 collectively. So you are phased out from your $40,000 amount down to 10. By getting married, you just lost $70,000 of deductions on your tax return, right? Like, I'm not saying don't get married. I'm just saying it's actually something to think about when you are looking at the cost. Again, probably not going to stop you from getting married, but you want to be aware of these things before you, like, what happened to all our money? Last year, we had so much more spendable cash. Why is our tax bill so much higher this year? Well, it might be in part because you lost $70,000 of deductions when you got married. Right? And I'm just making one example. There are other possibilities here, but it really creates what's called a marriage penalty under the law for individuals. That is not a technical term in the tax code. The marriage penalty is just a fancy name that tax and financial advisors use to describe the increased cost in taxes that can come about when two high earners get married, and as opposed to having two separate single tax bills, to having one collective joint filing tax bill. All right, as we continue with a few other things here, it also makes the income range between $500,000 and $600,000 of income, what I refer to as the Kenny Loggins area. Anybody remember Kenny Loggins? Like, what's his #1 song? Probably his most famous song. Let's see if anybody wants to type that into the chat. See if we can get that. Kenny Loggins, right?
Was it in Top Gun?
Yes, Top Gun. That's a good one. Yes. All right. We got Adam here as our winner. The Danger Zone. Yes. So that is exactly what I think about. The Kenny Loggins area for tax planning here is $500,000 to $600,000 of income. Here's why. If you make an additional $100,000 after having $500,000, you not only have to pay tax on that extra $100,000, but it causes you to have your state and local taxes go from $40,000 down to $10,000. So you lose $30,000 of deductions. So net, what happens is by making another $100,000, you pay tax on another $130,000. That is about a 45% federal income tax rate on that $100,000 only. That is a really high rate. There's not a tax bracket that's that high, but you're paying tax on more money than you're actually making. So we need to be very, very careful of that area. And then finally here, and this is the big point I want to get across more than any other for this slide. More of you this year will itemize. I said it's still going to be a minority of folks on this call in all likelihood, but more of you this year will itemize than you have in the past 6 or 7 years or so. And with that, because your state and local taxes are going to be high enough, right? If you've got $40,000 of state and local taxes between your income taxes and your property taxes, $40,000 is higher than your standard deduction, even without counting your charitable contributions, your medical expenses, etc. So you're going to go from not itemizing perhaps over the last 7 or 8 years to itemizing. What you really need to take away from this is start keeping track of things like your charitable contributions, your medical expenses again. You know, those are things. Your mortgage interest gets reported to you by your mortgage carrier each year, so that's less of a big deal to keep track of actively throughout the year. But if you haven't been itemizing for the last 7 or 8 years, you probably haven't been paying attention to each, you know, oh, I'm going to give $100 to this charity and I want to give $50 here. Look, if you're doing that, that is tax savings. That is a tax savings for you if you itemize. Keep track of those amounts so that you can add them to your itemized deductions, which you may now take if you have high state and local taxes. All right, let me pause here for a moment. Brian, I didn't know if you had any comments to add here before I move on. I thought you guys may be looking to chime in with a couple thoughts.
I have one amusing thought. When you talked
Okay.
about not getting married for tax purposes, my phone lit up and 4 clients texted me, either I'm canceling my wedding, and one person said, that's why I'm not married. So you must be striking a chord some folks in their personal lives.
That's amazing.
In our planning work, we have thought about this a lot. A lot of our clients work at large public employers or publicly traded employers, and they have non-qualified deferred compensation plans. So a bunch of people on the call have heard that term. That's a tool we've thought about to try to get people out of the Kenny Loggins danger zone. You have any other ideas to add to that on ways to get creative with receiving income?
Yeah, I mean, that's certainly a really big one because this is not based on taxable income. It's based on AGI, which without getting too technical means it has to be a deduction that's taken towards the top of someone's return. So either we're looking at things like a deferred comp plan where it's never added to income to begin with, so it doesn't even show up to start, or something like a pension plan for small business owners where we can drop that income, quote unquote, above the line. It could be using some accelerated depreciation methods. But the bottom line here is if you're in that $500,000 to $600,000 range, it pays to really be mindful of your income. And look, in some cases, I've had conversations with folks like, you're working like a dog, you know, picking up overtime shifts or all this stuff. And between you and your spouse, you're making, $580,000. Stop with the overtime. Take some time back in your life. Spend it with your family, your friends, your kids, whoever it is. Do the things that you enjoy. Yes, you'll make, let's say if you went from $60,000 down, $600,000 down to $500,000 of income. Okay, it cut your income at the top level by $100,000. But between federal, state, and local taxes, for a lot of people, that loss of $100,000 in that zone only equates to about $40,000 in their pocket. And I'm not poo-pooing $40,000. That's a lot of money to a lot of people, but it's all about what is your time worth and what are you working for, right? And in many cases, like, okay, I'm just gonna not put in all those extra hours. If I can work, 35 hours a week instead of 40, or I could go back to a 40-hour week instead of working, 10 hours of overtime a week, but I get that time back in my life to do the things I love, that might be worth it too. It's also worth pointing out, like, look, if you're making $800,000 a year of income, you're probably not getting below that. But what is interesting is once you get through that kind of Kenny Loggins zone, you end up with a lower tax rate. So when we talk to people, and when I talk to people who are not financial advisors or tax professionals, there's this misconception that as you add more income, your tax rate always goes up. And that largely stems from the fact that as you add more income, your tax bracket only goes up. That's true. But your tax rate is the total cost of adding more income, which takes into consideration if you trigger additional surtaxes or if you are phasing out a deduction like this or phasing out a credit. Once you phase out something, it's gone. You can't lose more. Like, you can't get back to below zero. So there are a lot of times when it actually pays to add income to a tax return to get back to a lower rate. It's a very, very counterintuitive thing. It's best handled, honestly, by looking at long-term or longitudinal projection software. So things I know you all have in your office that you can use to help clients come up with the right answers for these things. But it's a really interesting scenario to add income to pay a lower tax rate. Very counterintuitive. But one of the reasons why we do this sort of work for clients to help find those counterintuitive opportunities. All right, you also mentioned that you have quite a few folks who work for large employers. They may have incentive stock options. This is definitely news for those folks. This is what I refer to as the Back to the Future provision. That's why we got Marty McFly there on the screen. And the reason why is we're going back to the future with our income phase outs. When the Tax Cut and Jobs Act was passed, it dramatically increased the exemption amount for the alternative minimum tax and the income levels at which that exemption phases out. So today, after inflation, right, we went to $1 million limit for married couples filing a joint return back in 2018. With inflation, today it's at about $1.25 million. But next year, we're going back to the future and having $1 million income limit phase out again on that exemption amount. We're going back to the 2018 levels. Now, for those of you who are like, what is the alternative minimum tax? Or maybe you haven't thought about this for years because it probably hasn't impacted you since the Tax Cut and Jobs Act was passed. And remember, this is effectively like a shadow tax system that's done in parallel with your regular taxes. There's really two tax returns that are done anytime you file a tax return. There's your regular tax, which is kind of what you think about on your 1040 and so forth. And then there's the alternative minimum tax. It's just that the alternative minimum tax is usually lower than your regular tax for the overwhelming majority of folks. And if you pay the higher of the two always. So if your regular tax is higher, that's what you pay. But if the alternative minimum tax is higher, you pay that. It is likely that you still won't have to deal with the alternative minimum tax going forward because the exemption and the phase outs are still relatively high. But if you are someone who has a lot of ISOs, quote unquote, or that's short for incentive stock options, you are probably at a greater risk of running into the AMT than almost anyone else. And because of this change, you may have some incentive to pull forward some more of your ISO exercises into 2025 rather than into 2026 and beyond when those income phase outs drop back down. Again, if you have that, like make a mental note of this and say, okay, this is the thing I'm going to reach out to my Frazier financial advisor and ask about because I have ISOs and maybe it pays for me to pull in. So these are just things to continue to spark conversations. Real quick update here, if you're looking to adopt a child, that is now refundable up to $5,000. Pretty straightforward. We won't spend too much time there. I do want to spend some time, though, on this, just to let you know that there are near-term deadlines. Look, the One Big Beautiful Bill Act basically eviscerates the clean energy credits that are available in the tax code, phases them out, ends them way sooner. And there are tons of them. And I'm not going to bore you with every single one because your head will spin. What I have found is that most consumers, most clients are concerned with one of two credits, either the clean vehicle energy credit or the residential energy credit, right? So home energy efficient improvements or buying something like an electric plug-in vehicle. And if that's the case, the credit for electric plug-in vehicles, which does have some limits on income and there are some restrictions on which vehicles qualify, but if you're looking to purchase a vehicle like that, there's a $7,500 credit potentially available, but only through the end of September. And then there's also credits available for clean energy upgrades, but those are going to have to be done by the end of this year. So here's what I would say. This doesn't mean go out and buy an electric vehicle. It doesn't mean go spend money to upgrade your home to energy efficient things. But if you're thinking about doing those things anyway, like let's say your lease is up on your car in November and you were planning on getting a plug-in hybrid or you were considering it, well, it sure pays to like bump that up and maybe turn in your lease a little bit early, even if there's a little penalty, or pay a lease for 2 months while you're paying for your other vehicle, if you can get a $7,500 credit if you buy it before the end of September. Same thing with energy efficient upgrades. If it's something you're considering, it might cost you a lot less to do this year versus next year. So just something to think about as we move forward, okay? And don't wait till the last minute because dealers are aware of this, other people are aware of this, contractors are aware of this. There's going to be a glut probably towards the end, right? Everybody and their brother is going to go to buy a vehicle on September 30th if they know it's going to cost them $7,500 more to buy the same vehicle the next day. All right, as we move on here, some other provisions for business owners. This is also really applicable to those of you who may be real estate investors. There's a lot of benefits here for real estate investors in these two depreciation changes. One of them is that certain equipment that is available for the quote unquote 179 deduction, that is going to be eligible to be expensed immediately up to $2.5 million of eligible property. And so remember, most things, right, when you spend money as a business, you're either spending money when cash goes out, it's either a true expense, right? Like, oh, I fixed something. Well, there's no longevity to that. Like, that's just a cost. But if you go out and buy a building, you're not really spending that. You're kind of just changing the asset you have from cash, if you will, to a building. And so the tax code doesn't let you, in general, write it off all right away. You have to depreciate things over some period of time, over a asset's useful life. For commercial real estate, it's about 40 years. For, you know, some desks or furniture, it might be like 5 years, things like that. But it's not immediate. However, under Section 179, property that qualifies under this, which is a lot of machinery, software, things like that, you can expense up to $2.5 million of that right away, significantly lowering your tax bill. The same things apply here. The same principle applies with bonus depreciation. This is available for property that was acquired and placed in service after January 19th, so on January 20th of this year or later. And this is a big deal for real estate investors because it applies to depreciable property with a depreciable life of less than 20 years. And you might be wondering, but Jeff, you know, why do you say you just told me commercial real estate was 40 years. That's not 20 years or more. What does it have to do with real estate? Well, here's the deal, right? Let's say you bought a piece of property that had a building on it for $4 million. All right, I'm just going to make up these numbers. Normally, you have to allocate some amount of that purchase to the land itself, like the actual physical land the building sits on. And because land doesn't really go anywhere, land doesn't depreciate. So let's just imagine now that we bought our building for $5 million. We allocated $1 million to the land. So the building itself is worth $4 million. And we're going to depreciate this building over 40 years. So that's $100,000 of depreciation every single year. Here's where bonus depreciate comes into play. While the building itself, if you do nothing, might be a $4 million building, the reality is the shell of the building has to be depreciated, if you will, over 40 years, about. But there are things in the building. For instance, lighting fixtures have a shorter lifetime. The carpeting, the doors, like other things like that are installed in the building that are part of the cost, that are part of the $4 million, actually have a much shorter lifetime. You could do something that's known as a cost segregation study, which is a fancy term for having a bunch of qualified real estate professionals or accountants or other qualified individuals come in and they take your $4 million purchase price and they start allocating it. They say, okay, actually, $250,000 is for the lighting, and then another $100,000 is for the carpeting, and they figure out what is the total amount. It's usually about a third of the property's value, right? Especially on residential real estate, like you have a multifamily building that you own. It's about a third of the value, which means with bonus depreciation, you can write off about a third of your purchase price. In my example, $4 million divided by 3, you're getting about a $1.3 million deduction right away with a cost segregation study. And again, I'm using round numbers here and averages, but that's a really big tax benefit for those who are looking to invest in real estate. Another change here for business owners is the change for qualified small business stock. I won't spend a ton of time on this one, but suffice it to say is if you have a fast growing business that is not in general a white collar service business, so not doctors, lawyers, advisors, CPAs, things like that. If you've got like a widget making business or some sort of more blue collar business that is growing relatively quickly, you might want to reach out to your Frazier Financial folks, work with them, your attorneys and so forth, and evaluate whether or not it makes sense to look at qualified small business stock, converting your entity into a C corporation, which in most cases is not that efficient from an income tax perspective while you're running the business. But if your business is growing relatively quickly, you can exclude millions and millions of dollars. At a bare minimum today, $15 million of the growth of your business can be excluded when you go and sell it, to in some cases, in an extreme scenario, almost $750 million of gains can be eliminated when you sell your business. Now, I doubt many of you are going to sell a business for $750 million. That would be awesome if you did. But it works really great to eliminate $1 million or $2 million or $3 million of gain. Again, only applies to certain businesses, works best with fast-growing businesses. You do have to hold on to it for at least 3 years to see some benefit, 5 years to see the full benefit realized, but something to consider as we go on. All right, I'm going to skip the next slide and go on to some things that are meaningfully different here, because these are the ones that are a little bit more applicable for you. Beginning this year, so again, effective 2025, there's a new deduction. If you're 65 or older and you're on this call, there is a $6,000 additional deduction for you that you are available to have as long as your income is below the threshold amounts. You can see them here on the screen. That is in addition to your standard deduction, and it's in addition to your additional standard deduction for being 65 or older. So for married couples who are filing a joint return, who have fairly modest income, you have a standard deduction of about $31,500 plus another $3,000 or so of additional standard deductions if you're 65 or older. So that's $34,500 plus $6,000 for each of you as an enhanced deduction for seniors. That's $46,500 of completely tax-free income without any other deductions whatsoever. And as a reminder, this deduction for seniors is really neat. It's not an above the line deduction, so it doesn't impact your AGI or adjusted gross income, but you don't have to itemize in order to be able to claim this. So even if you're taking the standard deduction, you can take the standard deduction and the enhanced deduction for seniors. Now, I will point out, this has been marketed to a large degree as a no tax on Social Security provision. That objectively, that's not what this is. It is true, most people will not pay tax on their Social Security, but that was also true before this bill. It is true that more people will not pay tax on their Social Security, but it's not because Social Security is tax-free. That did not change. It's just that more people who are receiving Social Security have more deductions available because there's this senior deduction. And so now, instead of only being able to have $30,000 of tax-free income, you can have $46,000 of tax-free income. Most seniors don't have more than that. If you do, consider yourself to be one of those fortunate few. Is there a question here? Is there any proposal to make the deduction for seniors either permanent or to extend it beyond 2028? Nothing in writing or with teeth right now, but you can be sure that all of these, what I'm going to call campaign promise provisions, are going to be hot button issues come 2028. They are going to be things that people say, are you going to extend them? And it's not just a deduction for seniors. It's also this quote unquote no tax on tips provision. And more accurately, it's no income tax on some tips. In short, you can deduct up to $25,000 on your income taxes if you receive tips of up to that amount. You still have to pay employment taxes. So it's not no tax, it's no income tax. And similarly here, if you're someone who makes, who has overtime as part of their job, as part of the Fair Labor Standards laws, so you're getting like time and a half for certain work beyond 40 hours or so, you are going to be able to deduct up to $25,000 of the overtime wages on your personal return. There are some really wacky nuances to the way that this works though. So for instance, if you're making $100 an hour and you make $150 an hour for overtime, you actually don't deduct the $150. you deduct the $50 extra amount you're getting because it's overtime. The $100 base salary you're getting, you still have to pay tax on that amount as well. But this is another deduction that you can take even if you don't itemize. You can take the standard deduction and this deduction. And that also applies to the car loan interest deduction. These do have to be for vehicles purchased this year. So not any, you can't do this if you have an older vehicle, meaning vehicle purchased prior to this year. But if you purchase a new vehicle, that is going to allow you to deduct the car loan interest of up to $10,000, again, subject to some phase out limits. All right, with that, let me turn our attention here to some charitable provisions, because I know many of you on this call, and talking with my Frazier financial friends before hopping on, I know a lot of you are charitably inclined to at least some degree. There are a few changes here that are really impactful. The first one is that beginning next year, not this year, so this is a 2026 provision. All the ones we just talked about are 2025, the no tax on tips, the no tax on overtime, the senior deduction, the car loan deduction. Those were all 2025 provisions, but this one is 2026. And what this says is beginning next year, if you do not itemize, you can deduct up to $2,000 of your contributions to charity if you're a married couple filing a joint return, and everyone else can deduct up to $1,000. So historically, you've been limited to only deducting charitable contributions if you are an itemized filer. Now you can deduct this if you take the standard deduction as well, again, subject to those maximum $2,000/$1,000 limits. Now that's good for those of you who are not itemizers. For those of you who are itemizers, it's sort of bad news for the most part beginning next year if you're charitably inclined, for two reasons. One is, beginning next year, your charitable contributions are going to have to exceed 0.5% of your AGI in order to be deductible. So this is kind of similar to the way medical expenses work today, except the medical expense percentage is much higher. The medical expense threshold is 7.5% of AGI. So effectively, like this year, let's imagine you make $100,000 a year, to keep our math easy. 7.5% times $100,000 is $7,500. What that means is, for you, the first $7,500 you spend on medical expenses would not be deductible. If you actually spent during the year $8,500, you could deduct $1,000 on your tax return. Well, the same thing is going to apply next year for charitable contributions, but to a lower percentage rate, 0.5%. So what does that mean? It means if you are a $300,000 earner between you and your spouse, 300,000 times 0.5%, that's $1,500. The first $1,500 you give away to charity, you will see no tax benefit for next year. If you do it this year, that doesn't apply. Now, the other thing to keep in mind here is that beginning next year, the value of overall itemized deductions is capped at 35%. This impacts only those of you who are in the 37% tax bracket. What it means is, even though you may be at a 37% tax rate, when you make a charitable contribution, you will only able to deduct 35% of that, or you only see a 35% benefit for making that contribution. So net, you're paying 37, you're deducting 35, you're actually still paying a net 2% tax liability on amounts you gave to charity. So let me sum all of that up, right, with a what does it mean for you, what should you be thinking about doing sort of scenario. So here's the idea, right? If you are a non-itemizer, and let me take a step back. If you're giving to charity purely for altruistic purposes and you don't care about taxes at all, it doesn't matter. Right? But there are a lot of folks who say, I want to give to charity, but if I can give to charity and help myself have a lower tax bill, that's what I want to do. If that latter person is you want to support your charity, but you'd like to maybe see a tax benefit, if you don't itemize and you give cash, it may be better to wait until early next year to make some contributions, because next year is when that new $1,000 or $2,000 extra deduction for non-itemizers takes effect. Okay, that's not applicable this year, and those contributions have to be in cash. However, for those of you who do itemize or will itemize this year because your state and local tax deduction will be much higher than it's been, You might want to pull in deductions this year. Make your charitable contributions this year more so, because you don't have to deal with that 0.5% floor to get over. And if you're in the highest tax bracket, that's even more applicable because you won't have this new overall limit. All right. Before we wrap up our discussion here, let me shift forward and talk a little bit about the estate tax exemption. I'd be remiss if we didn't at least mention this. It's going to stay very high for the future. It is $15 million per person next year, so $30 million for a married couple, and that is a permanent feature of the law. The end result of this is very few of you have to worry about federal estate taxes. And that gives you the freedom to focus more of your planning around income taxes around death. Some other changes here that are not tax related. If you happen to be on a bronze or catastrophic plan on the exchange, those are going to be treated as HSA eligible plans beginning next year, so you can make an HSA contribution. There was a significant cut to Medicaid spending over the next 10 years, close to $750 billion cut out of the Medicaid budget. If that's something that impacts you or friends or family, you may want to look at how you're going to satisfy your medical expense or your health insurance needs going forward. In terms of 529 plans, if you have young children, grandchildren, et cetera, it's worth noting that beginning next year, more costs will be eligible to be taken out each year. Up to $20,000 will be eligible to be used each year for things like primary and secondary education. So if you pay for private school, it's often best, especially if you live in a state that has a state income tax benefit for making your 529 plan contribution, don't pay the school directly. Put $20,000 into your 529 plan, get the tax break at the state level, then turn around like the next day, take it out of your 529 plan and pay the school. That works in about, I want to say, 35 states. 10 states or whatnot don't have an income tax, so it doesn't matter in those states. So of the 40 or so states that have an income tax, it works in about 80% or 90% of them. It's a really good approach here. And then finally, student loans. This is something that I'm just going to say, if you have a student loan and you're on a repayment plan, especially one of the ones that was created while the Biden administration was in office, reach out to your Frazier Financial folks and figure out what needs to happen there. It is a nightmare scenario here. I feel so bad for students who are being bounced back and forth between programs that exist and don't exist. Whether you're a fan of administration, the previous administration, or you're a fan of the current administration, you don't like either, you love both. It is really unfair how much student loan borrowers have been have had the rules change for the game while they are playing it. And so again, we could spend an hour just covering the student loan changes that have occurred. Just reach out to your Frazier Financial folks. All right, I know that brings us to the end of our scheduled time here. I want to turn it back over to the Frazier Financial team. I will stick around if there are additional questions anyone wants to ask, but before I turn it back over, again, I just really want to emphasize the fact that it is so unique that your advisors took the time, effort, and energy to make something like this available. There are so many firms out there, very few of them really, they don't practice what they preach when they say we really value our clients and helping educate them. The Frazier Financial folks do, and that's why I am here today. I really value the way they do business and work with each one of you. And just again, thank you to all of you for joining. Thank you to my Frazier Financial friends for having me here. Again, I'll stick around, but back to you guys for a wrap up here, if you will.
Thanks, Jeff. Really appreciate all that time. So for those on the call, we've still got close to 100 folks. We have Jeff for an hour. He has very generously said he'd give us 10, 15 minutes of extra Q&A. So if you have questions, he's willing to take them. Josh and I certainly can chip in as well. And if you haven't found it yet, at the bottom of your Zoom screen, there's a Q&A section. There is also a chat section. We'd prefer Q&A, but you can send a question in through either one of those. Jeff, we do have one, which I think you can still see on your screen. I'm going to steal back the presenting from you, and I'll throw up our our deck here. Trump accounts, touchy subject because it has the name of an administration that half the country doesn't like, but they are kind of broad in who they're going to touch. So can you just give us your 2-minute bit on those?
Yeah, actually, I can. So let's start with like, what are these Trump accounts? So in short, they are built, if you will, on an IRA chassis. So they're accounts that are going to follow largely the IRA rules. They're going to be available to contribute for children who are under the age of 18. The most that can go into the accounts each year is $5,000. And they're going to be non-deductible contributions. So no upfront tax break for making them. The contributions do have to be, the investments have to be held in very specific investments. Basically, it's a US mutual fund or ETF that tracks the return of an index, does not use leverage, so no debt. It has an annual fee of less than 0.1%. And the money that goes in there is largely going to be untouchable until the individual reaches age 18. These accounts are not available yet. They won't be available until at least 1 year after the enactment, so looking at July 4th of next year. But effectively, what are my thoughts on them? Look, I think it's going to depend for me largely on what they allow with these accounts. There is some question as to whether or not you're going to be able to convert them to a Roth. If you could convert an account to a Roth for someone at 20, at 18, or maybe at 23 or 24 when they graduate college and the kiddie tax doesn't apply, there's a good chance that that person is going to be at a very low tax rate. And so making Roth conversions of what could be by that point a couple $100,000 of income in a really tax efficient way sounds like a home run for me. If you're looking at using this for something like college planning, I don't think so. I think you're going to be using a 529 plan because of the tax benefits. And if not, maybe even an UTMA or an UGMA account where at least some of those gains are going to be capital gains. It largely also depends upon what sort of investing you're going to do. But here's my thought. You're limited to a index account. Indexes or an index mutual fund or an ETF, those are fairly tax efficient investments. So if you're just going to buy a S&P 500 index fund, you don't really need the tax deferred wrapper of an IRA. It has, you don't pay taxes while you hold on to that investment. It kicks off very little income. So unless that individual, again, unless we're looking at doing a conversion at age 18 or beyond, which is still an open-ended question as to whether that's going to be allowed, I don't really see a huge benefit to making those contributions relative to other options you may have. Now, that said, for the next 4 years, for anyone born this year, if you've had any children, grandchildren, friends, or family members born this year through 2028, for every one of those children, as long as they open up a Trump account, there's going to be a $1,000 contribution made by the government into their account. That $1,000 might grow and be worth, who knows? It could be, $5, $6, $10,000 by the time that they are, 18 without any other contributions. You've got to open a Trump account in order to get it. Now, I know it's a highly politicized issue. I know, as you heard, half of you love the name, half of you hate the name. Whatever, if you love it or hate it, it's free, quote unquote, money, right? So I would open the Trump account and get the $1,000 if I had a child born here in the next 4 years. If you don't like the name, call it whatever. Call it your birthday account, whatever. But take the free $1,000. It's about as close to free money as you're ever going to see from the federal government. But again, in terms of long-term, would I put the $5,000 in here per year? I want to wait and see what the final rules are. Again, if it's for college or a near-term expense, probably not. If it is for longer-term savings, then there can be some benefit there. I do see another question came in here. With these additional senior credits, I'm going to pause there before I read the rest of the question. Say it's a deduction, not a credit. Remember, a credit is a dollar for dollar offset on your taxes. So a credit is always way better than a deduction. Oh, I lost the question. Let's see.
Oh, sorry. I marked it red. I got you, Jeff.
Okay.
Basically, Jane was asking if you envision an uptick or a reduction in Roth conversions, and maybe how valuable those are before and after these new provisions?
Yeah, it's a great question. So it's going to depend, I think, on where you fall in the income spectrum, because if you're low enough that you're not going to phase yourself out of that deduction, then sure, it's more tax-free income that you can have. And the more tax-free income you can have, it means it takes a higher level of income before you're out of the 10% bracket, a higher level of income before you're out of the 12% bracket. So all in all, yes, I do think that's going to lead to some more Roth conversions. But what you do want to be mindful of is if you're higher income and making those Roth conversions causes you to lose some of those deductions, that might spike your tax rate up higher. And so again, don't focus only on the bracket, you got to focus on the rate. And that's where, your advisors at Frazier Financial are doing that great work of seeing, okay, how much can I add? How much before I go to the next rate? Am I going to get back down to a lower rate, or will I spike myself up? Those are the sorts of things you want to keep in mind. What holes still remain for Congress to define in this law? Oh my goodness, we're going to need another hour and a half program here. There are always a lot of questions that come up after a law like this is passed, especially when it's written relatively quickly, as this one was. But I will say, relative to some other laws, there are fewer questions about this, largely because a good portion of this bill is just extending existing provisions. So in terms of holes for Congress to define, I also say this: it's likely not going to be a congressional issue. It's likely going to be an IRS thing. So basically, here's the way tax policy works. Congress writes the law. Congress passes the law. And then once Congress passes the law, the IRS goes to work. And in fact, in many of these areas, the law actually says will happen according to rules laid out by the Treasury Department, right? So the IRS actually is instructed to create some of these rules. That's via regulation. So the tax code, the law, is what Congress creates. That's kind of the overarching framework. What I think about is, like, if you were going to make an analogy to like the human body, it's like the bones of everything, right? And then the IRS comes along and it passes, or not passes, it issues regulations. And that sort of fills it. That's like the bones and the muscles and the skin. It fills out the skeleton of what was put there by Congress. And there are almost always surprises. So where I could sit here today and say, well, there's a hole here, there's going to be holes where no one has even thought of yet. There's almost always a handful of surprises. And that's why, I spend my life basically diving into this stuff and staying on top of it. It's why you have, advisors to help you with these sorts of things. Look, I sometimes get, my head wants to explode from all the number of changes and how quickly they come and how quickly guidance is issued. And this is basically all I do. I do still work with some clients, but very few anymore, because this is where I spend the overwhelming majority of my time, because there's not really time to do both really, really well. And that's why, one of my passions is trying to get out the word to advisors and folks like the Frazier Financial team, so that they can save more of their time to spend it with folks like you to actually implement this on the one-to-one client basis. Good question.
Jeff, I'll hit you with a big question. We can close on this one. We've gotten into a little bit of seems like political seesaw with legislation. So
Yep.
things like Roth were almost taken away and then not, and some things have been put into proposed bills that have not passed. What's your crystal ball on the next 4 to 8 years of tax planning? Do you think we'll have administrations constantly undoing each other, or what's your vibe there?
Do you have a harder question for him, Brian?
No, I want a hard question. He's the smartest guy in the room. He needs a hard question.
Well, so look, tax policy is almost certainly going to be dictated by who's in office, and who's determining who's in office this far out is really difficult. But in terms of the broader question there, like, do I expect things to change? I do. We are in a hyper politicized climate right now. And basically everybody's policy is, I'm going to undo everything the other person just did. Right. And it's been going on here for a while. It's not something new. It's been going on for really decades. If you think about when Obamacare, quote unquote, was passed, Republicans ran on the repeal and replace platform for, the next 3 or 4 years. And again, I'm not saying it's unique to them or any, like, it's both part. This is, I really don't like when everybody both parties is everything, but this really is a both parties do it. Both parties are out there trying to undo the work of the other party. And so, yeah, I do expect that if we have a Democratic president and a Democratic House and a Democratic Senate, that we are going to see a lot of this change. And it's important to remember that tax policy is different than just about everything else. Let's look at another hot button issue here, like gun control, right? Gun control is a hugely politicized issue. There are probably folks on this call who fall, on complete opposite sides of the spectrum. But you don't see gun policy change dramatically from one institution, or one administration rather, to the next. You don't have one administration coming in and saying, everybody gets machine guns and we're going to ship one out to every American free of charge. And the next administration come in and say, no one can have a slingshot anymore, right? And the reason why you don't have these wild swings, and I'm exaggerating for a point here, but the reason why you don't have these wild swings is because of the way legislation is passed. In most cases, you need 60 votes in the Senate to get to cloture. In other words, you have to vote in the Senate to get to a vote. And you can't vote to get to a vote unless you have 60 votes that say yes. And there are only a few exceptions to that rule. One of them is like on confirmations for justices, for Supreme Court justices, federal justices, et cetera. And the other one is for fiscal related policy that can be passed under a process known as reconciliation, which for our purposes today simply means like tax bills can be passed with a simple majority in the Senate. Because we're so evenly divided as a country, you almost never see the White House, the House of Representatives, and a 60 vote plus Senate majority, all of the same party. But you do from time to time see a simple majority in the Senate. And that's how we got Obamacare. That's how we got the Tax Cut and Jobs Act. That's how we got the Inflation Reduction Act under the Biden administration. And that's now how we got the One Big Beautiful Bill Act. So if you're asking me to predict the future, I'm going to say anytime one of these parties has complete control over the White House, the House, or the Senate, we are going to see meaningful tax provisions, and it's simply going to depend upon who's in the office. It makes it harder to plan because you don't really know what the rules are going to be forever or for the long term, even when they say they're permanent. But that's just why I say, while you still have to be mindful of what is likely and not likely to happen over the long run, when it comes to tax planning, there's a bias towards action while the provisions exist, because it's really one of those buy now while supplies last things, because we don't know how long supplies will last. So there's my answer.
Appreciate it. It sounds like good job security for you.
Yeah, one of the things I spend a lot of time worrying about a lot of things. Job security, candidly, is not one of them.
All right, well, we'll stop it there. Jeff, can't thank you enough. Really appreciate your time and energy and expertise. And everybody who joined us, really appreciate you guys devoting an hour plus. As always, we've got our contact info on the screen here. Jeff, we use the term primary advisor. Everybody with questions, either reach out to your primary advisor, or we've got our concierge email there. Jeff, hopefully we'll catch you in Columbus next year. Really appreciate you joining us.
Look forward to it.
Thanks, everyone.